Hi, welcome to Mortgage Insider Edge. Headline news this week, the Federal Reserve Vice Chair has just come out today in a speech and spooked markets a little bit. Brainerd says the Fed is to shrink the balance sheets rapidly as soon as May. So I want to explain what the balance sheet really is, because I don't think that a lot of people understand that. So from the Board of Governors Federal Reserve System website, I've got basically just a look back to July 2007. So this would have been right into the 2008 era where the stimulus money came in and TARP and all these programs were put in place to save the real estate market. The Federal Reserve had just under $1 billion in assets, and then in a short period of time had over $2 billion in assets, and continued to build that balance sheet until the spring of 2014, when they started the first round of what we'd call tapering, or reducing, letting the balance sheet run off. So they didn't do that in any significant manner. It stayed pretty flat at about $4.5 trillion until the summer of 2017. In 2017 into November, that balance sheet started to taper off or be reduced. Now into 2019, there was a change. Okay, August of 2019, the Federal Reserve cut their interest rate and they slowed down the tapering, actually picking up some assets until early 2020. And really, it was March 2nd. So a $4.2 trillion balance sheet has more than doubled in a very short period of time. Went up to $7 trillion in just a few months from March 2020 to May 2020. And then that has steadily been increasing on a monthly basis, and it continues to climb, just starting to see the top of what would be maybe a look back to in 2014 when they started to slow down their stimulus. So when they talk about tapering, or reducing the balance sheet, you can see that this is not something that's been done in an accelerated form in the last recession or the last turnaround from the recession of 2008. But this federal response is going to be similar if we wanted to look into the future. Okay, so big picture here, what do they own at the Federal Reserve? So they have different types of securities. So they have over 10 years, and then their total, they have 5.7 trillion in U.S. Treasuries. So that would be holdings in 10-year securities or even shorter-term securities with the U.S. Treasury Department. They have mortgage-backed securities, 2.7 trillion, and then reverse repurchase agreements. This has to do with banking. So this is their total balance sheet. When we looked at those total numbers, this breaks it down. But 10-year Treasury, if we wanted to look at the different types of Treasuries, you've got a 1-year, a 2-year, 7, 30, and 10. Okay, so just this last week, we saw the 10-year right before this today, as this 14 basis point increase has gone through. You've got 2.55% return for your money if you guaranteed over the next 10 years if you invest in this Treasury bond today. Okay, the 2-year, which just a few days ago was inverted. It was actually a higher rate of return on a 2-year than it was a 10-year, which I've talked about. That's the inversion of the yield curve. You can even see the 7-year is inverted. You get a higher rate of return for a 7-year bond than you do for a 10-year bond as of today. And look at this, the 30-year is 2.58. So these two are very similar as far as your rate of return. So 30 years tying up your money 3 times as long as 10-year. That tells us that markets think that over time, if this is going to be a hedge against inflation, 2.5 to 2.55 here is what the market's pricing into guaranteed return. Okay, now, what does that really have to do with interest rates today? Okay, that's really what we're here to talk about. Since November, the Federal Reserve Chairman has been in front of Congress, and he's talked a lot about transitory inflation. And it wasn't until earlier, just in the last 2 months, that they've acknowledged that inflation seems to be persistent, and they're going to change their response by slowly raising their short-term interest rate. So as a result, we've seen 1% in just the Treasury yield, 1.52 on December 31st. As of today, we're seeing this at 2.55, more than a 1% increase. That affects all interest rates, right? That 10-year is just a good benchmark to give you an idea of what's happening in the mortgage market, what's happening when you want to borrow money for anything, whether it's your car loan, it's your credit card. As the Federal Reserve raises rates, it's going to impact that. So quick update here. When you hear the Federal Reserve talking about reducing the balance sheet, that is additional pressure on the mortgage-backed security market and the U.S. Treasury market, driving up rates. They haven't actually done any of this yet. Talking about it is powerful enough at this point to drive the markets, and so everything is being just reactionary until there's some kind of data that either we wait a few more months and see if inflation starts to slow down. That could be a positive thing, and that could change the response or the tone from the Federal Reserve. But as you hear news items like today, that'll be the news item that interest rates rose again. Well, they're a little bit more than they were last week, which as of 3 days ago, it looked like we were going to be improving just a little bit. This is not good news. It's just where we live today. So there's your Mortgage Insider report for this week. Have a great one.